Very big shoes to
Interesting.
fill.
Yeah. All right. So we're going to talk about venture capital and the ecosystem. So thanks for coming in again. And one interesting aspect that people have been really curious about um, is what is venture capital at a deep level, but more importantly, what does that mean in today's context, right? Of 2022, the next decade, Southeast Asia. What does it mean for my company? And so I think, last year felt like it was all partying, right? And, maybe not for us, but, it felt like it was and then now the media, the stories of layoffs, of, the retreat, there's war, there's food insecurity. And so it feels like we kind of gone in reverse. So kind of like starting out, I think the first question has been, so what do you think about, Southeast Asia tech for the next 10 years at a high level? Why are you here? What do you see about that?
So I feel like venture capital is a really weird asset class, right? And I think it gets conflated with all sorts of funding, where the reality is most companies should not take venture capital. Um, and so if you think about sort of the history of venture capital, it was to fund crazy things that other people wouldn't fund: semiconductors, storage, chips, things that have high operating leverage. And the growth of what was a cottage asset class to today has meant that we fund lots of things that don't necessarily resemble some of those traditional profiles. And then I think the last 2 years, like you said, of the party, an incredible amount of quantitative easing and printing from the Fed and other governments in response to the pandemic have led to an incredible asset bubble and crazy amounts of money being deployed. Um, and that's not normal in the sense that that's probably not the regular side of things, but it is normal in that market cycles exist, right? So we always see boom and bust, we always see overexpansion and contraction, and we just happen to be in a contraction phase. But I think in terms of like what's next for Southeast Asia over the next 10 years, I'm incredibly bullish. I think if you think about what you need for a vibrant innovation ecosystem, you need capital, you need talent, and you need experience. And so for a long time, I think Minister Alvin is like, hey guys, we're putting a bunch of money into the ecosystem. That's a capital bit, right? The talent, I think, has been traditionally sucked into MNCs and more traditional industries. If you tell your mom you're going to start a company, they're like, why would you do that? Why don't you go get a nice, safe job? I think that is starting to change. You see more and more young people and parents being willing to see people come out. And then experience. We've just gone through the first kind of cycle of Southeast Asian companies going public or having exits. Maybe, I don't know, any Gojek Grab shareholders in the audience. Maybe not at the levels you want them to be, but still they made it out. And that I think is a huge accomplishment, kind of to see that full cycle. And now you start to see these people getting recycled in the ecosystem. So people who are part of those companies' growths. And so I think those three key factors give me a lot of hope and optimism. And venture capital is about solving problems, right? Startups are solving problems that exist. Venture capital is the fuel that helps fund those people. And Southeast Asia's got a lot of problems, okay? So that is opportunity, I think, to solve a lot of interesting things, right? Life is not easy and convenient in most places in Southeast Asia. Um, Climate, healthcare, transport. I think there's still a lot of things yet to be solved. So
Yiping? Yeah.
I started my first company around 2004, same as Minister Alvin. At that time, there was very little capital and an early batch of folks who are very willing to start. I think Mohan also kind of started around that period. There's a small bunch of us, and a lot of us are like daring and just want to try and don't care about failure. But there isn't much money out there, so we tend to be more, I guess, in some sense, resilient and spend very little, stay in mom and dad's place, and taking no salary for years. I think that has changed. I think now, fast forward to 2012, 2022. Um, right now, even though we are facing winter, I do feel that there is a lot more money than ever before. The maturity of the venture ecosystem is also is I wouldn't say super mature, but having lots of different players really helped for the scene to eventually get to that maturity. And I think in some sense, fast forward, if I want to look at the next 10 years, I am optimistic and I'm also hoping that this winter is helping to shape that, i.e., at a state where there's a lot of money, and then now there's lots of retrenchments happening. I do hope that startups kind of find a little bit more of the North Star on the kind of companies they want to build, the resilience that they can build also. And to a certain extent, also, it's not just about burning cash, right? It's also trying to, you know, be be okay to maybe take less salary, for example, or I mean, in a sense, be more thrifty and try to not be at a growth at all costs model. To a certain extent, I think that it is very fair for us VCs to be able to help invest in a company and know that this is not going to be profitable in the short term, and we're all okay with that. But just being able to know that the problem you're solving has a way to monetize one day down the road, and you don't have to grow in a sense of in all directions and in just a giant infantry of folks in the team. So I think that in the next 10 years, I do feel that whatever is happening right now in the next few years are going to really shape that. So I do think that the ecosystem will mature a little bit better in terms of even just the venture side. Talent on the entrepreneurship side, I think in the last decade, the governments of Singapore have been doing a great job getting lots of young folks to be interested, or even getting corporate levers to come in. And this has also kind of taken off in its own steps in all the various Southeast Asia emerging ecosystems. So I think that in itself is also very interesting. Just how I have seen it as a VC in the last few years, I have seen all kinds of talent now. In the 2004, it's mostly the new batch of talent or the entrepreneurs are the young fresh grads like us, thinking that, hey, we're willing to take the fall, we're still young, we can afford it, right? But now it's coming from young, it's coming from folks that who haven't even graduated, but also lots of corporate levers and just coming from all directions of folks returning, right, to Southeast Asia. So I think that the the dream here is, to create that diverse set of entrepreneurs, and same thing, the diverse set of VCs. And I think then this two part of the ecosystem, I think at least on the demand and supply, is quite well done. Then in between, I just really care a lot more about the soft parts, right? The resilience, the kind of people we want to see grow in the next 10 years. I often think that you need to put capital where you believe, right? And it's not just about believing in um, just full transactional or capital optimizing, but also the kind of folks that we think can impact our world.
So I think I mean Shiyan and Yiping have given quite good overviews of the evolution of VC, right? But this I'm reminded of this really good Steve Blank video on YouTube on the history of Silicon Valley, and a lot of it actually had to do with the innovations that were needed in World War II, and the venture capital industry alongside the research firms were the ones that really invented a lot of the technologies that helped the US win the war, right? So I think venture capital had idealistic visionary starting fronts, but over time, that has evolved, right, over the last 10, 15 years. I mean, when even when E27 started, right, we started it for two reasons, right? One is we genuinely believe that startups can make the world a better place. right? From in that idealistic viewpoint, but on a bigger level, if you look at Southeast Asia, it has a ton of problems. I completely agree. And to be fair, I'm talking about this in 2012 context before Grab even existed, right? So when I say a ton of problems, yes, really, and I still think it does, right? And the teams that can really get these problems solved are fast, nimble, innovative groups of people that are willing to take big bets, big risks, and try completely radical views. And those are startups. And I think venture capital is that mechanism that enables all of that to happen. Now, along the way, that might have been lost, maybe to a certain level to pure greed, or on some level to just funding what is popular or interesting, right? But but going back to that basic core thesis of venture capital, where it's all about innovation, big bets, radical ideas, is also realistically not so simple, especially in a market like Southeast Asia, where the startup ecosystem is still very, very nascent. So I think that there needs to be a few waves, right? Like what Shiyan rightfully pointed out also, right? The first wave is more or less done, right? Where you've got the first group of entrepreneurs that have come in, the first group of VCs that have taken a significant amount of bets. I mean, it's so easy to say now that, oh, investing in carousel is a great idea. Doing that in 2012 was a totally different thing, right? It required a different kind of mindset. It required a realization that a classified type platform could work. So so that framework of VC has now passed. The next evolution and the next framework of VC is really going to be around big problems, climate tech issues, cybersecurity issues. I think in our current context, even defense related issues, right? And you will have a different group of founders, right? Founders that might have done it before in the first round and won a much more difficult, serious challenge. Or founders that have this renewed sense of building for the next 30 years and wanting to
Life
really work on hard
extension,
problems.
Mohan.
Huh?
I
Life extension is another big one. Yeah, that's a huge area too, right? So I think that evolution will need time, and I think we will probably see it in Southeast Asia over the next 10 to 20 years.
Amazing. So, what I've gotten from this is that, on an absolute basis, Singapore and Southeast Asia is better today in terms of venture capital and entrepreneurship support versus 10 years ago. Um, and to some extent, of course, it seems worse or is worse versus 2 years ago. Yeah. Okay. So let's dive into this because
Thanks.
that. So actually, I'm on the same page, right? It's like I feel like I read a lot of U.S. tech news, and it looks really bad. And I think it also has that same. And I think there are some ripple effects to Southeast Asia, of course. But to me, I do feel like maybe read less U.S. news and read more Southeast Asian news and understand the facts. How do you think about that?
Yeah, I mean, VCs are sheep, right? That's what founders love to say. Oh, they don't recognize my genius, they're not funding this. But I think so I think there's the unkind version and there's the kind version, right? So the unkind version is like, yeah, if you're a momentum investor, you should be a sheep, right? Because that's how you're gonna make money on the way up. And then the kinder version is if you're an early stage investor and you don't think other investors are gonna follow on, then you shouldn't invest in it because you're just setting your own money on fire. And I think in the big boom of the last 2 years, a lot of funds got raised, right? A lot of angel investors were minted, and a lot of money was deployed. And now I think you're kind of seeing the flip side of that in the US, right? So the amplitude of that wave was bigger in the US. There's less money in Southeast Asia. Some of it did leak out from the US, right? So you started to see international funds become tourists in the region and starting to write their checks, right? Whether it's Tiger, Hedo Sophia, Insight, all these guys started write their first Southeast Asia checks. But we've had less of that inflation. And so I think that is probably why we don't feel as depressed. Um, but I mean, I think the shoe is still dropping, right? I think you are still going to get in the next 6 months. There are companies that are going to get recapped, cram downs, pay to play. I think we will see all of those things, and you will see like these slow deaths. First the layoffs, and then they're like, oh, okay, I'm not going to be able to raise. Do I keep going or not? So, is it better or worse? I think we are probably better off in that a lot of money got raised for Southeast Asia in the last 2 years, and those people all need to deploy. We don't get paid to sit on our hands, so that's better. Are we worse off? I mean, I think people who over hired and over expanded, yeah, they're gonna be worse off. But I always tell people you don't start a company to raise money. I hope not. Anyway, you start a company to make something that solves a problem that people will pay you for.
Vanity metric.
Uh, so, and I also tell people starting a company is insane. It is fundamentally an act of insanity. There are many other expected probability things you could do with your time that are better value. So, the insanity has to match the opportunity, and so, but yeah, that's the better or worse. Who knows?
I actually think that, of course, the context right now, like Shiyan said, write downs happening soon, recaps. I do think that the worst is not even now. I think the worst is like next year or so, right? Where there will be more massive recaps. Companies have to either go through slow death or suddenly realize they have so much payables because they haven't registered that. Um, I do think that in terms of if we can see, you know, in terms of the available funds, it would be for a company, it probably is more conservative. Lots of VCs are now trying to concentrate on rescuing current companies. We have this consistent debate internally. Do we rescue or do we invest in new, right? Because new is a ray of hope. Rescue, we don't know. Um, so I think we are going through this kind of like uh, equilibrium, right? So we are trying to moderate and find what is the new norm. And in some sense, maybe on the capital side, it is not so good for the new startups coming up. But Shiyan just raised a new fund, and Mohan and Milan here sitting also launching a new fund. So that we have a lots of rays of hope. But on the other end, where it's about, let's say, really testing the maturity of our ecosystem, I think it's a good thing because in the last two, well, not just two, I think in the last 5, 6 years, Southeast Asia has this phenomenal growth that we're just VCs are saying, my God, I got into this deal. Is it like, am I just going with formal? Or is this I really have conviction? The startup founders is just like pressuring us to sign within a week or today. It's like, what? I don't even have time to talk to the team. So we have gone to this very weird extreme of VCs no longer call the shots for the last several years. And not that we are able to call the shot exactly right now, but I'm just saying that we need that phase where startups also need to realize that it's not just about raising funds anymore as a vanity metric. And even if you have raised a fund, you still need to be cautious on where you spend it. Where are really your growth levers, true growth levers that can be sustainable, rather than you are burning millions of dollars a month just to acquire, but you have a huge leaky bucket, right? So I think it's good for the ecosystem, and it's gonna shape how the next 10 years look like. Yeah.
Yeah. Actually, just to provide some data for context, right? And it's just nice timing this came in today, right? So there was the 34% month-on-month decline in global venture capital, right? And there was like a 56% year-on-year decline since July last year. So these are quite large drops, right? So as of last month, there was about 27.7 billion in global VC deployed, and actually this is the lowest apparently November 2020, right? So like it's very easy to get caught up with large numbers like this and suddenly think, oh no, venture capital is drying up and all of that. But when you go into the deeper nuances, right, you actually realize that the later stage or large scale numbers are definitely reducing because the prospect of exits have been pushed back by a few years. So there's a natural shift in investment in smaller ticket sizes on a much earlier level. I'm still very bullish on the Southeast Asia venture capital scene. Just this year alone, right? I think there were more than 500, five funds that have more than 500 million Excel, Sequoia, looking to deploy capital. Every other day, you read about some new early stage fund being launched, right? I think if you have a good company, getting funding is never going to be a problem. The major shift that I agree a lot with what Yiping said, right, in the last 5 years is that um, there has been a complete disregard, right, for a lot of the fundamentals and the unit economics with respect to funding. partly because of the amount of capital that existed in the industry, but partly also because of the low interest rate environment, and the bullish run of tech, right, for the last 10 plus years. So I think the investor mindset is definitely shifting. There are naturally to some level more interesting investment opportunities outside of technology. So we are in a situation where tech is going to go through a lot more scrutiny in terms of unit economics, in terms of the viability, and I think that level of pragmatism, right, and coming back down to earth, right, is the right shift forward for the entire ecosystem.
So what's interesting is that everyone is saying that the worst is not here yet. It's going to happen over the next 6 months to 1 year. And what's interesting is I was talking to some bankers and they think maybe the stock market has hit the bottom, potentially hit a floor, and may bounce up, in time to come. So when you say the worst is not yet here, how bad do you think it's going to get? What does it look like visually, you think? Is it more news articles? Is it more, you know, shame, more failed founders? What does that look like, right? When you say the worst is not here yet, what does that mean? Um,
Ooh. Well, I think one thing to remember is failure is part of startups. Most startups should not succeed. Like, otherwise, we're not taking big enough swings. Um, so, but I think from the worst perspective, right, if you start with layoffs, you saw people do layoffs in Q1, Q2, and then you're going to start seeing people do more layoffs because they didn't cut enough in Q1, Q2. So you already saw that Robinhood just cut another 20% because first 9% layoff was not enough. So I think that's kind of, you'll see more layoffs. And then you'll see more startups just die because they can't raise the next round. So if they raised, let's say Q3, Q4 last year, they were probably planning to raise another round end of this year, early next year. But what they're seeing is it's harder to get a meeting. Meetings take longer, all this sort of stuff. This cascading effect. And then on the VC side, we don't mark to market, right? You do a quarterly report, and then you do an annual audited report back to your LPs. So your last annual report was the end of 2021. Everything looked really good. And then everyone dies, and then you don't mark all that stuff down. And then that impacts your next fundraise cycle, right? So I think that's kind of like what I think of as like the worst. And then I think on a terms perspective, right, which is okay, maybe you can raise again, but the new investor coming in is like, hey, all you previous investors, you better pay up now, otherwise we're gonna cram you down. And I haven't really seen that yet, so I feel like that's just part of the cycle, and so you should start seeing that kind of happen. I don't know if you guys are starting seeing that.
Yeah, I really do think that all these activities of bad news are going to come out one by one. For the first time, I think when we start reporting, maybe next year, for the first time, new funds or even longer vintage funds are beginning to see more significant write-downs because the company officially shut. Um, in the past, I think you always have a little bit more like liquidity out there. You can still survive another year, right? You buy another 12 months of runway. But I think the runway is
Out.
yeah, totally running out even for funds like us. Um, but what is also invisible here, and I'm beginning to see already, is not enough new companies being funded. I hope Shiyan can deploy. That's why that was my first question. Hey, are you deploying? and
We wrote 4 checks last month. Hustle Fund VC. Send in your application.
and yeah, so both sides are deploying, and I just feel like the more founders I'm talking to right now, the more they just cannot get into VC meetings, and so I'm also advising the angel route. Angel is still proving to be a bit more resilient. At least I think 80% of my angel associate friends are still investing. So I'm also doing my bit in the angel side. But it is true that, what Shiyan said about if I also want to have visibility that you can raise your next round. Otherwise, actually, it's just our personal money burnt, right? So in that sense, I think we're gonna see that. We're gonna also see more startup founders with very early ideas go back to maybe their corporate jobs or find something else. Yeah, which is again, it's pretty normal. I just feel like don't take it too hard because the cycle, the boom and bust is gonna happen, and truthfully, yeah, most startups do not make it.
The best thing about going last is they actually answer 90% of all the points raised. So,
Yeah, you
Go
start
first,
and
you
then
go
Start,
I'll
start
go.
this time first, okay.
so,
okay.
so I can just quickly summarize, right? So my when I think of things turning bad, right, the part that worries me the most are founders that are optimistic, because founders are generally optimistic, right? You kind of have to be, right, with all the shit you go through. But when founders are optimistic to a level, right, where they are lying to themselves, and not making or doing the hard things needed to either cut or think through the rethink the business, right? That is going to be a problem. So what is happening a lot now is, of course, there are a lot of bridge rounds. Founders are raising like half a mil to a mil in bridge rounds. Some of their existing investors are supporting them. The challenge is when, or the problem will come in when founders raise a bridge round and operate the company exactly the same way as they were doing before the round came in, right? And then it's really just a slow death, right? I think that way of thinking has to completely change. And if I were investing in the company, I'll have a lot more scrutiny on how are they changing, or how are they reducing costs, or at least how are they getting to break even as quickly as possible to conserve runway. The second thing is that I think a lot of there has to be a lot deeper thinking of their unit economics, right? Naturally, in because of the upcoming recession environment already we are in, right, there will be a lot of changes in terms of expectations that companies can pay, budgets that they might have in certain areas. So depending on the nature of your company, right, your ability to get revenue is going to change significantly. For some companies, actually, it could be a lot easier. So that might change the trajectory of your firm. But for most companies, right, it's going to be tighter, the ability to sell. And then your sales cycles are also going to get longer, right? And then unfortunately, with the inflation environment, your employees are also probably going to ask for more salary, or switch jobs. So there are a lot of these multitude of issues that if founders don't take very active, difficult steps now to fix these, it's going to kill them off very, very quickly, right? And I think that's going to be the nail in the coffin that will really push the ecosystem over the ledge.
Yeah, we have one last question, and then we do actually have space and half an hour for people to ask questions. So please get ready to think of some questions, and then I'll be happy to repeat the questions and for everybody to say. So, I think it sounds really scary, right? In the next year, a lot of fear, and there's gonna be bad news. And I think one trend I've seen, obviously, is I think the news cycle. And so, Mohan, you'll be going first this time around. I think there's been like a what I call a lionization of founders over the past few years, in terms of media, and so forth, in terms of bravery, and so forth. Um, and they're almost starting to feel like there's a de-lionization, right? I think was the founders' fault, right? Responsibility, failure. And I think we see that with recent profiles in the media of other founders in Southeast Asia and the Singapore ecosystem. Um, and I always remember that one of the stories I've heard was, in the media you only have three stories, right? You're either the hero, you're either a villain, or you're an idiot, right? So those are the only three roles that you can have, right? And so the pendulum seems to be swinging that, and the media story is very much like, is the founder's fault, or is the VC and the board's fault, right? And so I'd love to hear your perspective. Like, what do you think is how should we approach this, like a fundamental perspective, in when we open up the news, right, about these upcoming bad news and next year ahead, and responsibility and culpability and so forth. How should we think about that?
Yeah.
So I'll start with Mohan.
Yeah, we're very willingly go first with this because this is close to my heart, this matter. You like even at E27, we get like founders get pissed off with us because we might not write about their funding rounds or not feature them, like unlike maybe other media outlets, right? And the thing is, so I think early on we recognize very clearly, right, that media as a tool, right, if used ineffectively, right, could be very detrimental to founders because they get distracted. I mean, you can look at the number of founders that spend more time getting press coverage or speaking at events than actually doing work, right? And I think that's a very bad thing, right? So we have taken the stance on at least on E27 side, right, to do more thought leadership content, to do content that are really more how tos and not just purely featuring a founder or featuring a round. Because we all know as founders, right, like raising the round, right, is the start of the work, right, not the success metric that you should be aiming for. So I think the ecosystem stakeholders, and this involves like the media, the government, and event platforms and all that, right? They do have a responsibility, a fair responsibility towards making sure they cover, they showcase the right people and do the right thing. The second part is also founders themselves. Media is fundamentally a tool, right, to get an outcome done, right? Media isn't a tool, right, to get you visible or to help you with fundraising. And I think that's another very serious problem that founders actually need to learn quick, right? That once you use media as an avenue to fundraise or as an avenue to market your product, right? I think it's a very downhill slope, right? The focus really should be on your customers, your users, right? And that's what really should be the driving force behind it. The last part with respect to media in this entire landscape, some media companies will profit from your downfall, right? Like it or not, right? There are many media companies, whether it's as a subscription model or whatever, right? The moment shit hits your fan in your company, they will lap on it and they will monetize it. Okay. The unfortunate truth is that is the business model of the industry. So don't take it too hard. Don't take it too personally. The right or fair thing that you can do, right, is just provide information as much as you legally can in a fair manner as possible and let the ecosystem decide. The investors, the employees, and the general ecosystem is sophisticated enough, right, to know when you really screwed up versus when the idea didn't work. And in a lot of times, right, the ideas don't work, right? In media, the most important thing is to learn to control the narrative. So if and when you are put in such a situation, right, always be more vocal, more open to sharing it. Don't hide, behind the shades, right? Because the more transparent you can be about failure, about your own personal growth, and about the mistakes you've made, right? Actually, the more respect people have for you. And I think in VC, right, you want to be supporting founders that have maybe failed and giving them another chance because the lessons they learn, right, could actually be very valuable for investors. So that's my quick spiel on media.
I'm actually a very genuine empathizer of founders who really try their best, right, to solve that problem, and have always been very thrifty in the progress of doing that. So and truthfully, even before the last 5 years, I think the normal stats in a US has always been, companies 80 to 90% fail. And of the ones that survive, how many become unicorns, right? Like true unicorns. Um, so I do think that when news do come out, I feel there's this big part of us that should be empathizing. That someone out there tried to solve a problem, and as a result, it's not like maybe it's not like a job where entrepreneurship often has this 0 and 1 binary matrix. I feel like it's either you succeed or you fail. It's like, why is it so binary? I mean, it's also a journey. The founders are also learning what work, what don't work, what is suitable for them. And I think that there is that fair element that we should use that lens to look at that objectively. But then I also draw that super clear line where some founders can be ultra negligent, right? The starting point wasn't great from the onset. It's a lot about I want to be this famous celebrity founder that, like Mohan said, overexposed in PR, and you're just scratching your head wondering, are you really doing the real work? Most of the time, I see good founders, they don't try to always snatch the limelight. Um, but again, not that you are visible means you're a bad guy too, right? So it really depends, well, what is that, balance, and again, starting point. In the last few years, because of the mass amount of liquidity we have, uh, the scene has favored models that actually can try to use the growth at all cost model, which is, I feel, also created lots of bad habits. Um, I do see that founders start to pay themselves like super stellar salaries, and we we are the ones who when we question, I mean, we're like, you don't have to take carousel level 500 a month for 3 years. You don't have to take 1,005 a month like shop back for also 3 years. No, you're saying a fair level of living, etc., but not when you are corporate salary level. So I think um, when we look at this news, really just try to land their eyes on facts. And I also have known certain venture investors who just want to ensure that a company can grow like crazy, right? Really super speed and really taking money as steroids, right, to grow. So there is that fair bit of certain investors' theses are just geared towards that. And it's the owners on founders ourselves to really figure out the kind of money you take. What does that mean to in the first place? Is it a grow, grow, grow kind of, the pressure that you get? Or take the money to really figure out, iterate and quickly figure out what's working, what's not working, and just create a good foundation. Yeah.
Yeah, I mean, I think this is part of the maturation of the ecosystem. So I suspect a lot of the early hero narratives were like government driven to say like, hey, it's okay to start a company. It's okay to take a riskier thing. And there are a lot of stories about that. But I also think part of an immature ecosystem is like when a founder says I want to pay myself 20K a month, you're like, you do realize that is less runway for your company, right? Like let's follow this train of thought all the way through. And also that at least in the valley, founding is often a multi-turn type of situation. A lot of people don't succeed in their first time and they come back again to market with their second startup. And if they behaved honorably in the first go around, people will fund them again. But I think here the startup ecosystem is so new that everyone's like, wow, all these crazy venture capitalists are like writing checks on God knows what, on no proof. Like I should go try to get myself some of that money. And they kind of don't really think it through, right? Which is like, hey, if I don't act honorably and treat my stakeholders ethically, I'm not going to get another bite of the apple. And so, you know, I think it's hard when the cycle is 10 years because you're like, oh my God, what's going on? But, when you look at the history of venture capital and you look at how people play through, um, once we get that flywheel going, I think it will reinforce better behaviors because then, all the other founders around you will be like, hey man, what are you doing? That doesn't make any sense, you know? And so hopefully, this sort of crash or contraction will try to like remind people what better behaviors are. As an industry, we should punish people who are not ethical, and we should not fund them again, no matter how compelling they sound. Um, and I think also as employees or parts people who are part of the startup ecosystem, we also have to hold each other to a higher standard. So like that's how I think we like try to shape the narrative ourselves rather than allow the media necessarily to do it for us.
Thank you for sharing that. And I think we're opening the floor for questions. So I believe you have one person here. Just share your name and question. Yeah. I'll direct this question to Shiyan. Yeah.
Um, it's really hard. I think you've probably already gone through this exercise of zero basing your budget and to like ask yourself like, hey, if I didn't have all these people in the company today and I kind of built my model from the ground up, what is the must have and what's the nice to have, and is there room if I cut the nice to have and retain the must have to compensate my remaining people or initiatives more. And then I think also being really honest about like who is the A plus talent in my company that I need to retain, and that investing in their future and paying them more now and retaining them is gonna, over the next 18 months help me more than saying, hey, I'm not gonna do the 5-10% increase. But that's really hard, right? Because I think the inertia of a company is that if you're already on the boat, it's really hard to get people off the boat. It feels bad. And then, or thinking more about performance related compensation, saying like, hey, if as a company we do well this year, we'll pay out more in bonuses to give yourself some flexibility there. But it's a really hard one. So I don't have a perfect answer for you. Thanks, Jeremy.
Look for anyone else's questions. Please raise your hands. Let's start with John.
Yeah, actually, I'll double down on what John said. Right, I think for angels, it's not like you're going in to lose money, right? That's not your intention, right? There are better ways to throw money away or burn them, right? But if your incentives are just purely to make a return, right? Then the original start process is wrong, right? I look at angel investing as shaping the world in the way I want the world to be shaped, or in areas that I believe are going to make the world better. But I can't do it myself, right? So I have to do it with people that I trust, or people that I like, or people that I believe in, right? And if that outcome results in a return, then it's a good environment for everyone. And then again, like what they rightfully pointed out, right? If you have the right actors in the ecosystem, if people are doing the right things, working hard, the outcomes should be positive. Then the VCs will come in. There will be a real business around it, and then it should have a positive return. But the angel investment layer, I mean, the Ron Conways of the world, right? Really invested in companies. Purely from the position of like they want the world to be shaped in a certain way, or they want certain problems to be solved that are just not getting tackled. And here, if they found someone to do it, they will give them money.
But Mohan, shouldn't we just complain about it and then the government will fix it, right?
The government can't fix everything, right? You need good founders to want to solve the problems in the first place. I mean, if you look at guys like, for example, I don't know, Steve and Wavemaker as an example, right? Like they're looking at climate technologies, and their struggle is they've got the money, they just don't have the any founders to invest in, and those are really big pressing problems to solve. Can you make money on a climate tech fund? I think that's still very questionable for now. But is it a huge problem to solve? Is it worth allocating capital to it? Hell yes.
I'm on your side. Just
I think for you, yep.
Jaya. Fantastic panel, and Jeremy, great job with building this community, and big fan of the podcast. My question is actually a two-part question. One is, what do you think the objective of the VCs entering Southeast Asia is? Purely because I see it as, I think they see it as purely a source of a growth, and not really to invest in innovative startups to the level at which they invest in, let's say, Silicon Valley, right? Do you think that's true, or do you think their objective has changed since they entered the market 5, 10 years ago, in terms of actually investing in startups that are not just replicas of something in Silicon Valley for like a localized version for Southeast Asia or Asia in general? So that's the first question in terms of the objectives of funds. And second, I guess more for Yiping, do you have any thoughts on corporate venture building and corporate VCs?
So, what
second
Yiping,
one?
why don't you start first, and then I guess Shiyan, I
First
guess
one,
you
the
can go
first
for
one is
the.
interesting too, though. Yeah, the first question. Yeah.
Okay, Yiping can do both. Okay, Yiping want to do
You
both?
can add on.
I'll chime in.
Um, your first question on what VC set out to do, right, in Southeast Asia. To be honest, I'm confused now. I think
Make money.
so exactly that was so that's the thing, right? Like VCs, we always think that VCs have the money, but every investor has an investor. So if our fund, the first fund don't do well, the second fund doesn't happen, right? So it becomes quite realistic that your first fund or your next fund also must start to show that it is promising. Yes, early returns in the paper because you're not really exiting. So you are also making the right choices. Um, and in the last few years, I've actually started seeing lots of I guess VCs for good or for bad, right? Concentrating on a few elite deals led by very elite founders, and there is that path of a small handful that becomes the elite, and then there is maybe a very slim bottom of founders that actually I truly want to back, like truly fixing problems that I identify with, I resonate. I don't know if you're gonna get the next fund or round of funding or not. But quickly within one fund, one can learn very easily and very fast that there needs to be this kind of equilibrium. John's question talks about angels, but actually John's question also has a kind of a deeper meaning when it comes to seed VCs or actually any other VCs after that, right? Where I actually see a lot of deals are made into very big giants very quickly within a span of 1-2 years. The growth trajectory to become a unicorn is less than 3-4 years, and there is that a group of VCs doing that, and then many of us who try to stay true to try and still invest in potentially big bets, a bit unknown, very good founder, may or may not come from super sexy backgrounds. We're still trying to, ensure that they have this first round, right, of survival. Quickly, then we start to realize that they may or may not get second round of funding because maybe it's a bit too new, doesn't really fall into anyone's thesis. Um, but to make that long story short, I feel like VCs have a specific thesis. Number one, make money. Number two, go after the sectors of growth that can make money. Third is invest in founders who can raise and eventually make money. So I think eventually this is again no right and wrong because we raise money from pretty you know expensive sources, and the expectation is for us to return. Um, and and thus we are seen to a lot of us have to also work towards that. That's the playbook, right? And then it's back to us VCs, whether or angel investors. Do we half play the game? Do we play the game in a very, say, intelligent way? But do we also have a small part of the portfolio or an allocation of portfolio that actually also that are not so usual or by the typical checklist? So that's my take on the first one. But eventually, I do think that the more VCs we have in the industry, the better anyway we will become, because everyone will start to figure out their thesis. The boom and bust will also help us all figure out, what it means to create that stronger uh, set of vintage funds.
I mean, I think the Silicon Valley VCs come here because they want to make returns,
Yeah.
right? Valuations get inflated in the valley. They're looking for lower entry points, and so they're going there, and their LPs are willing to fund it. So, like, everyone has a boss, right? So our boss, the VC's boss, is the LPs, LP, some endowment, some insurance fund, or whatever, and they need to return money to, their premium holders, their universities that they invest on, whatever it is. And so no one's in this. This is not a nonprofit. This is not a social impact fund. People are here to make venture capitalists. It's in the name, capital, right? Here to make money. Um, but I mean, I think on the question of deep tech, like, and are they here to fund proven business models? Or are they here to fund deep tech? Like, um, I think one of the magic things about Silicon Valley is that industry and academia are very closely intertwined, and that actually goes back to the war and a lot of the Department of Defense spending that happened in the U.S. So between Stanford, Berkeley, San Jose State, Santa Clara, Lawrence Livermore Labs, like, I mean, I don't know if anyone here's from the university, but like in the Bay Area, there are professors who go back and forth between academia and industry, and that's very normal.
Yep.
I can't think of the last time an NUS professor is like, "Hey, I'm going to get off the tenure track and go start a company." That's just not normal, right? And so I think if you really want to be able to build that ecosystem more, we have to continue to build those relationships between industry and academia to make that path viable. Those things, by definition, take longer, take way more capital to invest to see them through, and you need to have that practice. Like, even in the US, it's not like other universities or areas do that as well as Silicon Valley because they have like the 60 years of practice doing that. And so I think that's why, like, if you come here, your risk adjusted bet is a model that has worked in India or China, hopefully with adjusted lower multiples and valuation entry points. And you want to ride it and see whether it works or not.
On that note, Yiping, could you share your point of view on CVC and keep it tight? And then I think we have space for one last question.
Yep. On the CVC question, I think there are also like three things. There is venture building, CVC, and then family offices. So I think on the topic of CVC, there are several CVCs, right? In Southeast Asia, mostly ran by the big corporates or big family offices with very, say, strategic value that they can provide. There is value in getting CVCs to be involved. However, I do think that a founder needs to be aware the kind of alignment that you would need thereafter upon receiving the money, right? Because some CVCs want you to really use their resources more. That's how they also have synergy within the portfolio. That's how they have to justify back to the balance sheet holder to say that, hey, I'm investing on behalf of the company, of the corporate. So I would like to use that as a way to create, let's say, a pipeline of startups that in which later on you can tap onto. So there is that good and the bad. And the good tend to be that they always have lots of relationships internally to introduce you. Then the cons is that if you are aligned with one specific corporate, are you also, thereby making some other corporates uncomfortable, right? So they may not invest in you. So then the other way, sometimes I think that it is a little bit safer to take family office money rather than a CVC, because typically a family office also tries to run like a VC fund. They have less strategic need to map, right, a startup back to their whoever they're taking money from. There is that relationships, but it's less that need of requirement, right? So I think generally speaking, as VC money becomes a bit more conservative or might be concentrating on existing portfolio, I do these days actually recommend folks to also consider family offices, where the they are also generally speaking seeking a more sector agnostic, diversifying type of portfolio. So there is still money there, provided that it's not coming out of the stock or the crypto portfolio. Uh, so I think I quite like family offices, and there are many right now. So while we say that money has dried up a little bit, there is new pockets, right, coming up all the time, and these are new like new forms of money coming in, and there's also another interesting rise, right, in venture building. So there's so many venture building right now. I'm with McKinsey Digital, which is also in venture building, and we help later stage startups to really try to differentiate from their competitors, and for big organizations like corporates to prevent disruption. And also, there's many types like Rocket and so many names these days, right? And I feel like the rise of venture building is an interesting one and it's rising quickly. I wouldn't call it maturing yet. Everyone's just trying to find the model that would be one day neutral enough, more VC palatable. Many of the venture building outfits take too much of stake away from the let's say the initial founders, so thereby making it not very VC palatable. Um, so I think the models are changing, and recently I think many of the rocket offshoots are becoming more palatable for VCs to fund. So that in itself is also quite interesting, and I would also not so much say totally recommend, but I think it's something that one should consider to be with an outfit that can provide different skill sets.
Awesome. One last question out there. Anyone? Okay. You? Yeah, behind. No, not Milan. Behind. Behind you. And we'll keep the answer to about a hot minute.
Right.
Yeah.
Thanks so much, Darren. Thanks. So again, two questions. Just to squeeze it in. First one is, last 6 to 12 months, have you guys recommended any of the startups to conduct layoffs? And then the second question is, I think based on my little experience, I see a lot more startups in the US laying off and rescinding offers. I don't really see that much here in Southeast Asia. Do you think it's because we are more conservative in terms of valuation, or it's going to come sooner or later? Thanks.
Sounds like a question for Yiping and Shiyan. Keep it tight.
I'm a pre-seed investor, so most of my company is actually pretty early, and so they mostly have not hired up that much, so they don't actually have that many staff to lay off. I would say that what we've advised companies in the last 6 months is to take a good look at their budget and to run scenarios, as Milan has said, and to think about, hey, if I can't raise on my earlier timetable, what does that mean for my plan B? And I think the layoffs in the U.S. that you see are really from the bigger companies, and that's because imagine you raised 30 million bucks, you had this big ambitious growth plan, and you went and hired up against it, right? So a lot of people in that growth plan aren't actually delivering revenue yet. They are the promise of future revenue, right? So you think you can't raise in the next 12 months, you're going to cut them first before to try to stay alive long enough and do what you can with your existing crew.
Yeah. Generally speaking, I can safely say all investors are asking their startups to take a very good look at their runway. The guidance is to extend your runway by at least 12 months if there's even money left. But if not, if you just raised the round, we recommend extending from 2 suddenly to 3 years, right? Yeah, so um, cost optimization can come from reducing marketing spend, to really hire what you need. And so I do think that right now everyone is saying that. So it's not unusual, and it's going to be the norm for the next year too.
Yeah, none of my portfolio has even laid off. Actually, there's only one change that happened in one of them, where they did a merger with another company. So they actually consolidated their efforts, and they became a bit leaner, lah. So it wasn't a layoff, but it was like a consolidation of people in two different firms doing more or less the same thing.
On that note, thank you so much for sharing, and we're on time.